Silver just lost 5.6% in a single trading session, $4.37 per ounce, gone in 24 hours. The biggest one-day move silver has put in since the post-CPI crash earlier this month. And here is the part that should grab you. Silver is now sitting at $73.36 per ounce. That is 40% below its all-time high of $121.67 that it printed back in January of this year. 4 months, 40% drawdown. While the structural supply deficit has not eased by a single ounce, while BHP just locked in a $4.3 billion silver streaming deal that says where the smart money thinks this metal is heading. While 6 consecutive years of global supply deficit have built a cumulative shortfall approaching 800 million ounces, the macro storm is real and brutal. The structural setup is more attractive today than it was at $120 in January. Today, we are walking through every piece of that picture. This is the Silver Report. I am AI, Ryan Matta. Real Ryan put this script together earlier today after watching the carnage on the silver tape, made his notes, and handed it off to me to deliver while he runs his calls. If you stack silver, if you are watching this market trying to figure out whether the recent sell-off is a warning or an opportunity, this is the episode for you. We're going to walk through what actually happened to silver this week, why the macro picture moved against it, why the underlying supply story has not changed, and what the smartest mining companies on the planet are doing right now while everyone else is watching the price chart panic. Let us get into it. Start with the price action. Silver closed the most recent full trading session at $73.36 per ounce. That is down $4.37, a 5.6% drop in one day. The day before that, silver had been climbing. It hit $77.54 on Monday, up over 2% on the back of dollar weakness and Asian physical demand. Then Tuesday delivered the slap, 5.5% gone in 24 hours. That kind of whipsaw action is what silver does when macro forces are dominating the tape. It is what silver always does. The metal has a beta of roughly 2 to 3 times gold during macro-driven sessions. When gold drops 1.5%, silver typically drops 3 to 5. Yesterday was the textbook version of that pattern. Gold lost 1.7%. Silver lost 5.6%. The ratio held. So what caused the move? 3 things stacked at once. First, US. Inflation data continues coming in hotter than the market wants. The April Producer Price Index print was up 6% year over year. That number is the highest annual producer price inflation reading since 2022. Producer prices feed into consumer prices over the next several months. So when you see a 6% PPI print, the bond market knows what is coming next in the CPI numbers, and yields adjust accordingly. The U.S. 10-year Treasury yield has been pushing higher all week. When real yields rise, meaning the yield on bonds minus the inflation rate, non-yielding assets like silver and gold face mechanical selling pressure. There is no interest payment on a silver bar. So when you can get paid more to hold a Treasury bond, the opportunity cost of owning physical metal goes up. Capital flows accordingly. Second piece of the macro puzzle is the new Federal Reserve chair. Kevin Warsh took over as Fed chair on May 15th, replacing Jerome Powell. And Warsh has already made his stance clear. There will be no rate cuts this year. There may even be a rate hike before the end of 2026. That signal alone repriced the entire precious metals trade. Coming into May, the consensus expectation was 2 to 3 rate cuts in 2026 starting around September. That expectation has been demolished. The market is now pricing in a roughly 40% probability of a rate hike before the October Fed meeting. That number was essentially 0 a month ago. Higher for longer means precious metals have to fight upstream against the dollar and against real yields. Gold and silver both face the same headwind. Silver, because of its higher volatility, faces a stronger version of it. Third is the Middle East. Crude oil briefly topped $112 per barrel on Brent following Trump's weekend warning to Iran. The Strait of Hormuz situation is still unresolved. Iran is openly launching Bitcoin-settled maritime insurance infrastructure around the choke point, which we covered on the Bitcoin channel earlier. Higher oil prices feed inflation directly. Higher inflation pushes yields higher. Higher yields put pressure on metals. The chain of cause and effect is mechanical. And right now, every link in that chain is pulling in the same direction against silver. Now, let me give you the number that puts today's sell-off in proper perspective. Silver's all-time high is $121.67 per ounce. That high was set on January 29th of this year, roughly 15 weeks ago. Silver is now trading at $73. That is a 40% drawdown from peak to current price in 15 weeks. That is a brutal correction in any market. For some perspective, when gold goes through a 40% drawdown, it makes headlines for months. When silver does the same thing in 4 months, it gets buried in the noise because silver is volatile by nature. But 40% is 40%. Anyone who bought silver at the January top is deeply underwater right now. Anyone with cash on the sidelines is being offered the same physical metal at a 40% discount versus 4 months ago. Same metal, same supply, same demand, 40% cheaper. That gap between price and fundamentals is the entire trade because the fundamentals have not changed. Let me walk you through them. The Silver Institute forecasts that 2026 will be the sixth consecutive year of global silver supply deficit. The 2026 shortfall is projected at 67 million ounces. Cumulative supply deficits across the 6 years are now approaching 800 million ounces. To give you a sense of scale, total global annual silver mine production is roughly 820 million ounces. So the cumulative deficit is approaching 1 full year of total global silver mine output. That gap has been filled by drawing down stored silver reserves, by recycling, and by above ground inventory that has been quietly disappearing from vault systems all over the world. Now, here is the part about silver supply that most investors do not understand until they look at the data. Roughly 70 to 80% of all silver produced globally is a byproduct of mining other metals: copper, lead, zinc. When mining companies design and build a copper mine, they are making investment decisions based on copper economics, not silver economics. The silver that comes out of that copper mine is essentially a bonus product. If the copper price rises, more copper mines come online and more silver comes out as a side effect. If copper demand softens, fewer copper mines get developed and the silver byproduct stream shrinks. Silver supply is structurally inelastic to the silver price itself. That is a critical concept. Even if silver doubled from here, you would not see a meaningful supply response for years. The reason for that delayed response is mining project lead times. From discovery of a new ore body to meaningful commercial production typically takes 7 to 15 years. That includes geological surveys, permitting, environmental review, financing, construction, ramp up to design capacity, 7 to 15 years. So even if every silver-focused mining company on the planet started a major new project today, the additional supply would not show up in markets until the early to mid 2032 at the soonest. That structural constraint is the single most important number for long-term silver holders. The supply story is locked in, demand is the only variable, and demand is where the picture gets even more interesting. Industrial silver demand reached an all-time high in 2024 at well over 600 million ounces. The single largest industrial use case is solar photovoltaic panels. The solar industry consumes roughly 120 to 130 million ounces of silver every single year. Global solar capacity is expected to reach approximately 665 gigawatts of new installations this year. Every megawatt of solar capacity requires silver as a key conductive material in the panel construction. That demand stream is structural, expanding, and largely non-recoverable. Once silver gets embedded in a solar panel, it exits the available supply chain effectively forever. There is no economic way to recycle silver out of a solar panel at scale. The same is true for electric vehicles, electronics, and AI infrastructure. Industrial silver gets consumed, not held. There is one bearish wrinkle in the industrial demand story that needs to be flagged, honestly. Solar manufacturers are aggressively thrifting silver content per panel, meaning they are engineering new panel designs that use less silver per unit of output. The Silver Institute projects that 2026 industrial fabrication demand will actually decline by about 2% to a 4-year low of roughly 650 million ounces, partly because of this thrifting effect in solar. Some forecasts suggest silver demand from the photovoltaic industry could drop 19% this year as manufacturers substitute cheaper alternatives where possible. That is real. It is a legitimate counterpoint to the structural bull case. But the bull case response is that even with thrifting, total solar installations are growing fast enough that net silver consumption from the sector keeps rising, just at a slower pace than installations alone would suggest. And the substitution options for silver in many applications are limited. There is a reason solar manufacturers were paying record prices for silver throughout 2025. Now, let me bring you the bullish counter narrative that hit the wires today from Bawden Capital, which is genuinely interesting and gives you a framework for thinking about where the silver opportunity might be heading. Jen Bawden published a piece arguing that silver is set up for what she calls a great rotation. The thesis is straightforward. The US equity market, particularly the AI and tech-heavy NASDAQ, has been running on enormous valuations for 2 years. The MOVE index, which measures volatility in U Treasury notes, just had its largest one-day rise since March. That kind of bond market stress historically signals that allocator capital is starting to reassess risk across the board. If the tech sell-off deepens, the capital coming out of overvalued growth names has to go somewhere. Bonds are unattractive at current yields relative to inflation. Cash is losing purchasing power at 6% producer inflation. Real estate is impaired by elevated mortgage rates. The asset class that historically benefits from this kind of rotation is precious metals. Silver specifically is positioned to benefit asymmetrically from that rotation when it comes. The reason is size. The total silver market capitalization is tiny relative to gold, relative to bonds, relative to equities. Even a small reallocation from technology capital into hard assets can push silver dramatically higher because there is not enough silver available to absorb large institutional flows without major price impact. That asymmetry is exactly why silver tends to outperform gold during precious metals bull moves. It is also why silver gets crushed harder than gold during macro risk-off events. Same coin, both sides. Bawden's framework lines up with what Bank of America has been forecasting for months. Their 12-month silver target sits between $86 as a base case and $135 to $309 as upside scenarios. JP Morgan projects silver could average $81 per ounce across all of 2026. Silver is currently sitting at 73. So even on the conservative Wall Street targets, silver is trading below the consensus average for the year by a meaningful margin. Now look at what the actual smart money is doing while retail investors panic on the price chart. BHP, one of the largest mining companies in the world, just entered a long-term silver streaming agreement with Wheaton Precious Metals. BHP received $4.3 billion upfront in exchange for silver linked to its production at the Antamina mine in Peru. $4.3 billion. That is the largest silver streaming transaction by upfront payment in history. BHP is not in the business of giving away future silver cheaply. They are locking in capital today against a metal they believe will be substantially more valuable over the streaming agreement's lifetime. Wheaton is not in the business of paying $4.3 billion upfront unless they believe the long-term silver price thesis is materially higher than current spot. Both companies looked at the same fundamentals you and I are looking at and made a multi-year commitment in size. That is what informed money does at silver lows. So let me walk you through how to actually think about silver right now if you hold it or you are considering adding to a position. First, the macro storm is real. The Warsh Fed signaling no rate cuts is genuinely bearish for non-yielding assets in the short term. Higher oil prices are genuinely inflationary. The treasury yield environment is genuinely unfavorable for silver right now. None of that is fake. None of it is going to resolve in the next 2 weeks. The path of least resistance for silver in the short term remains downward until either the macro picture shifts or until silver hits a level where physical demand from Asia overwhelms macro selling pressure from Western paper markets. Second, the structural setup has not changed. 6 years of supply deficit, 800 million ounce cumulative shortfall, industrial demand that is structural and non-recoverable. Solar manufacturers continuing to consume silver at scale, even with thrifting, mining lead times of 7 to 15 years. That means no supply relief is coming this decade. Gold to silver ratio at 61-1, which is at the upper end of the historical normal range. When that ratio mean reverts back toward 40 to 50, silver dramatically outperforms gold. That mean reversion has happened in every previous precious metals bull cycle for the last 50 years. Third, the entry point matters more than the timing. Silver at $73 represents a 40% discount to the January high. Anyone who has been waiting for a meaningful pullback to add to their position is being given exactly what they asked for. The question is not whether silver eventually recovers. The question is whether you have the conviction to add at prices that feel uncomfortable in the short term, because the macro picture is screaming sell. Every previous silver bull cycle has rewarded the people who bought during exactly this kind of macro-driven pullback. Everyone, because the structural fundamentals always reassert themselves when the macro tide turns. Fourth, the rotation thesis from Bawden Capital is not hypothetical. The MOVE index spike is real. Equity volatility is rising. The AI valuation question is starting to get more attention from serious allocators. The conditions that would trigger a flight from overvalued growth into undervalued hard assets are visibly building. If that rotation arrives within the next 12 to 24 months, silver is positioned to be the disproportionate beneficiary. Bank of America's high case target of $309 per ounce sounds extreme until you remember that silver gained 130% in 2025 alone. Silver does not move in normal market increments when the conditions align. It moves in step functions. The bigger picture story for silver has not weakened. The dollar is sitting near multi-year lows against gold despite the recent metal sell-off. 6% producer inflation is not a transitory number. The Fed leadership transition during an active inflation reacceleration is genuinely destabilizing for fiat currency confidence. Sovereign central banks continue accumulating gold at the fastest pace in modern recorded history, which historically pulls silver along in its wake. Industrial silver demand from the energy transition is locked in for the next decade by global climate policy and electrification investment. None of that has changed because silver had one bad trading session. The trade is straightforward in concept, but psychologically difficult in execution. Buy hard assets when the macro chorus is loudest about why they should keep falling. Wait for the cycle to turn. Get paid handsomely when it does. The hardest part is sitting through the drawdown without panicking. That is why most retail investors lose money in precious metals. They buy the top because the news is most exciting at the top. They sell the bottom because the macro fear is loudest at the bottom. The contrarian read on silver at $73 after a 40% drawdown in 4 months is exactly the opposite. The boring answer is to keep stacking on schedule, ignore the daily noise, and let the structural setup play out over the next 2 to 3 years. That is the silver report for this week. If you got value out of this breakdown, hit subscribe right now. We do these market briefings every single trading day for both silver and Bitcoin, walking through what is actually moving the metal in plain English so you can make sense of your stack. Subscribing is free. It tells YouTube to keep this content in front of people who need it, and it costs you nothing but 2 seconds. Second thing before you go, head to bitcoinmaxing.com. Real Ryan built a free Bitcoin retirement calculator over there. And even if your focus is primarily silver, the calculator is useful for modeling out diversification scenarios across precious metals and Bitcoin allocations over a long time horizon. Plug in your numbers, run the math, see what makes sense for your situation. Completely free. Link is in the description below. I am AI Ryan Matta. Stay sharp out there.